the fixed income market, as I mentioned earlier, we saw a backup in yields from zero point 0.9 to 1.75 in a little more than 3 months this year. And in the bond market, that kind of move, nearly a doubling, think about that, is massive. And we've been very gratified to see the equity market kind of power through it. The equity market, I believe, has looked at it as, hey, this is the market working. The economy is very strong on the mend here, and there is a risk of inflation. So very natural to see this happen. The bond market players, I know, have been quite shocked at the move. One of the things that surfaced, and I haven't heard anyone speak about this, I've seen very little written about it, um, something called the SLR. It's a capital ratio that financial services institutions have to abide by. Um, the during the coronavirus, uh, the, the the Fed gave banks leeway and said, okay, you can count long-term treasury securities in your capital ratios to help you out here. Well, what I didn't know until a week before that leniency ended was that it was going to end March 30th of this year. And there was a little hullabaloo over it. There were some politicians saying, don't give the banks any more breaks. And so it did end. And lo and behold, interest rates seem to have settled down here a bit. Could it have been that banks were big sellers in the first quarter of treasury bonds and drove the treasury yield up much faster than normally would have been the case? It may have been so because we've come down from that 175, not very much, but a lot of economists were saying, oh, straight on to 3% or straight on to 2.5%. I think a big surprise and a support for the equity market here is it hasn't continued. Um, what we've also seen in terms of excitement is the Archegos, uh, the Archegos drama, for want of a better word, and that was just the case, it seems now, of one entity leveraging up far too much with one bank not knowing how much exposure other banks had to the same firm. And it seems to have been an isolated event. Again, we've been quite reassured at by the equity market's reaction uh, to, to, that, to that accident. It looks like it was a real accident because if departments around the world had said, okay, cut down on all of your risk, that would have been a recipe. The combination of interest rates going up the way they did, and the Archegos leverage cascading into decision making by risk officers. That didn't happen either. So these have been battle tests for the equity market, and I have to say the equity market has done very well. Now, the rotation that we talked about last week is still well underway. I mean, last month, still well underway. We are still seeing the market favoring cyclicals and value, but growth is clawing its way back. So if you'll remember the last time I talked about this, um, excuse me. So we said last month that this rotation was a very healthy thing because it meant the bull market was broadening out. And I think the two examples I just gave you, overcoming those, is another battle testing. So we're very optimistic about the equity market, and the way to look at this rotation is the market's broadening out, but it is going to be another launching pad for growth strategies. At some point, the market will recognize we've seen the biggest cyclical burst in earnings and it will look for growth once again elsewhere. And of course, innovation is a great source of growth. We are also seeing energy, the top performer, up 27%, and financials, the second, 19%. And as I mentioned last month, that's almost reassuring to me and us because those two sectors we believe are going to be disrupted, if not the most, almost the most relative to other sectors. So the confusion that I mentioned a little earlier, deflationary forces, cost pressures, and so forth, um, are probably going to hit them pretty hard. It doesn't have to be in the next 6 months, but the market is a discounting mechanism, and we believe the market will start to look at some of those indicators. So we are gratified to see growth beginning to engage once again, and we think in a good, strong market that will continue. Now, there is one thing I'd like to address before I finish up here, and that is we put out a podcast on our big ideas. Brett Winton and I had a conversation. Brett is our director of research. And Big Ideas 2021, if you haven't seen it, please go to our website, arc-invest.com. I think it's the best piece we put out all year in terms of giving investors a very broad view of the opportunities that we see evolving from the exponential growth trajectories that the 14 technologies around which we have based all of our research and which are supporting the five major platforms. So we laid those out in the podcast, and Elon Musk responded to us and asked the question about, I guess it's the Warren Buffett indicator. I didn't know it was called that, but it is a ratio, the equity market cap in the U.S. To GDP, which is as high as it's been really with the exception of the tech and telecom bubble. But if you go back about 100 years, this is about as high as it gets. And so we've done a lot of research on not just the past 100 years, but prior to that as well, because the past 100 years, and especially post World War II, where we have the best statistics, they've been good guides. The highs and lows, the bases, and so forth. But we're in a new era, and it's much more like the late 1800s and the early 1900s. And if you look at that same ratio back there, it's much higher, much higher. And I think one of the reasons for this is the denominator. GDP is made up of both real growth and inflation. And if we're right, and these five major platforms, 14 technologies, are all deflationary in nature, and they're going to become a bigger part of the economy. Think electric vehicles going from 2.2 million sales globally last year to 40 million in 5 years. And we think the growth in the US is going to be as fast as that 82% compounded at an annual rate. If that's right, and these major deflationary forces begin to move the GDP needle, it means the denominator is moving down. All other things equal, to say deflation pulls the denominator down relative to the numerator. And that means the ratio is going up. So I think you do have to go back to the last time we saw major innovation platforms evolve at the same time. There were only three back then: telephone, electricity, and automobile. There are five now: DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technology. And they are going to deliver profound changes in the global economy, including the U.S., of course. That stat, the the one that I think someone published being at nearly an all-time high. That was I think that was a post-World War II chart. Anyway, the deflationary forces of five innovation platforms are going to be powerful. And then add on top of that the deflationary forces associated with companies that have not done the right thing over the last 20 years. Uh, those two are going to be tugging at GDP. And I think pushing that ratio higher. And when you think about it, if we're right on this deflation call, then the long-term treasury yield probably is not going to go much above 2.5 or 3% if we're right. And that suggests that the valuation of the market uh, could be somewhere in the 30 to 40 times. It sounds crazy, right? Right now, we're roughly 20 times, a little more than that, maybe, prospectively. But the idea that it could double sounds crazy, and I agree with anyone who thinks that sounds crazy. But there is a possible rationale out there. Are we betting on it? We are not. We have a 5-year time horizon, and when we slap a multiple on the fifth year, we are using really normalized for what we're seeing today. We're assuming that many of these technologies look like they're mature at the end of year five, when in fact they probably will not be. We're just trying to be conservative. And so, as I mentioned last time around, for those of you who have been concerned about the volatility in the markets, the volatility in our strategies, all that did from our point of view is give us bargain prices so that we started once again to concentrate towards our highest conviction names uh, and um, and got some great opportunities as the rotation into value was taking place. It was taking place out of names like ours, and we will use those opportunities every time because our price targets are not going to change. These long-term price targets are based on well-defined cost curve declines and the price elasticity of demand estimates. If we get a change on either one of those, then of course we'll adjust. But a volatile market is not going to change anything in our 5-year targets. So we're very excited about the equity market and also innovation. We love the fact that we're engaging on Twitter with Elon Musk and lots of other executives and investors and innovators and individuals. And we love getting those sorts of questions. We need to stay on our toes. That's what we intend to do. And and so with that, I'll wish you a very happy spring weekend.